interest rate goes down means the cost of borrowing is lower. Businesses and individual has more incentive to borrow money to spend. When they spend in the economy expanded, business goes up, profit goes up, stock prices goes up. Okay, next. An investor is convinced that the stock market will experience a substantial increase next year because corporate earnings are expected to rise by at least 12%. Do you agree or disagree? Why or why not? Anyone? You agree or disagree? Okay, disagree. Yeah, the answer is disagree. Okay, the answer is disagree. Because it depends on this 12% whether it will be captured by the markets. Okay, reflected on the stock price already. So, assuming that the market is quite efficient, so this 12% would have been captured by the current price. So therefore, what's the question asked again? Uh, Stock price will experience substantial increase next year. So the keyword here is next year. Stock market will experience a substantial increase next year because corporate earnings are expected to rise by at least 12%. So the question is that if this 12% is expected, all right, expected, and it will be, if let's say the market is efficient, market will be very quickly capture this prediction, this information. Therefore, when it comes to next year, you won't see any substantial increase in the stock price next year because this expectation already reflected in the stock price before next year. Okay, so when it comes to next year, you don't see substantial increase in the stock price. So it's about expectation. So this question again is about expectation. All right, expected, unexpected. Um, that's why when it comes to earning, okay, corporate earning season, the one that I mentioned just now, in the month of let's say April, a lot of company will report their would disclose their financial performance, okay, their P&L. So when the profits is something that is already projected based on the consensus, based on the projected number, you won't see market reacted to that so much one. Okay. Um, let's say the company announced the profits of last year is 10 million. But if this 10 million is already expected, therefore you won't see market reaction to it. Not much market reaction to it, to this good news, even though it said 10 million. Right? However, if let's say the projection was 5 million profit, but then this company reported that it has made, let's say, 10 million is unexpected. Then you will see a market will react to it. Okay, the market will react to this unexpected good news. Okay, okay, number 7. Now, to arrive at an estimate of the net profit margin, why would you spend time estimating the operating profit margin and work down? So this is the question. Now, this question basically is just to tells you that it is important to understand or to work from the operating profit margin, in other words, from top to the bottom. Even though at the end of the day, what you want is the estimate of net profit margin. Okay, but then it is always good to understand what is actually happen, what actually cause or lead to this net profit margin as such. Okay, so you need to understand from the beginning. So that's why it's good to work down from operating profit margin, okay, and then minus the so-called the cost of goods sold, minus the operating expenses, minus the interest, minus the what do you call taxes. Then of course at the end you get the net operating profit. Okay, but to understand this is always go back. You need to start look at from the beginning. Okay, because there's a lot of thing in there, which means you have a lot of things to look at to for your analysis will be useful for your analysis instead of just looking at the final number that you want, even though that is the number you want, that net profit margin. But it is always understand the detail behind this net profit margin. Okay, it's good to it's very helpful and useful for your analysis. Okay, number 8. You are convinced that the capacity utilization next year will decline by from 82% to 79%. Explain what effect that only this change will have on operating profit margin. Okay, is this good or bad? Is it good news or bad news? Capacity utilization decline. Is it good or bad? Yeah, anyone? Is it good or bad? Yeah, it's bad. Okay, it's bad. That means you're producing less lah. Okay, you're producing company producing less. Okay, company producing less. So when company producing less, what happened? The profit margin will decrease. Why? Because you have overhead, which is fixed costs. All right, depreciation per unit, output, all this will goes up. Okay, all this will goes up. So when this goes up, the profit margin will become thinner or smaller. Because these are all fixed one. These are all like um, what do you call? Is fixed. That means you have to already spend on fixed cost. It's fixed cost. So you already spend. So when you divide by the outputs, then on the average or per unit level, it become higher, which means the profit margin will become lower. Okay, last one. Now you see an estimate that next year hourly wage rates will increase by 7% and productivity increase by 5%. Okay, hourly wage rates increase by 7%. This is not good news for the company. However, productivity increased by 5%. This is a good news for company. That means each worker can produce faster, right? So it's good by 5%. So what would you expect to happen to unit level costs? Okay, discuss how this unit level cost estimate will influence your estimate of the operating profit margin. So like I said, question 10 is the same, same as number 9. Okay, so this one, you just have to use this formula. So this formula is very simple. Basically, it's just in this case, it's a 7%. Sorry, this is not 6%, this is 7%. Okay, later on when I share, can you please change it yourself? This is 7%, not 6%. All right, so 7% increase in the hourly wage minus the productivity of 5%. So which means the difference is 2%. 2% increase in the unit labor cost, okay, which is not good news, of course. All right, unless the productivity is higher than the hourly wage increase, then of course it's a good news. All right, that means the unit labor cost will be reduced by that difference. Okay. All right, so the unit level cost is negatively related to profit margin. So this increase would, holding other factor constants, decrease the aggregate profit margin because it is a low rate of increase. So the effect on profit margin should be small. In other words, it's only 2%, so it's not really a big deal. So anyway, this question is basically on this part here. Okay, all right. So that conclude our tutorial for tonight. Now, any questions?